Okay, hi, welcome back to this course on infrastructure finance. This is lecture 23. We will continue our discussion on project finance markets in this lecture. The topic that we are going to talk about in this lecture is financial intermediation. We will try and cover some of the salient aspects that we see in financial intermediation in the project finance markets. But before we actually do that, we will try and answer the thought questions that we actually put forward in the previous lecture. So question number 1 was, we saw three types of debt facility generally. We had the base facility, and then we had the working capital facility, and then we had the standby facility. So the question was, which of those would have the highest and the lowest interest rates? So let us try and analyze the major features of each of these three loan facilities, and then by a process of induction, let us try and derive what would actually be, which of these facilities will have the lowest and the highest interest rates. Okay, so let me write it on the board. So we have the three types of facility. We have the base facility, then we have the working capital facility, and then we have the standby facility. So let us analyze these three loan facilities in terms of the various features of these facilities. The first feature would be, let us say, the term of the facility. So base facility is more or less like a term loan, so therefore it is going to be a long term facility. Okay. So this will be a long term facility, whereas working capital facility is essentially a facility that is available after the project begins operations and is needed to take care of the working capital requirements, that is to bridge the deficit in the cash flow cycle. So essentially the duration of the working capital facility will technically be short, and it's going to be on a revolving credit basis. So we have what is called as a short term credit for working capital facility. And then what is going to be the standby facility? Standby facility is essentially to take care of any exigencies, any excess in terms of requirements as compared to what has been budgeted. So therefore the standby facility is actually going to boost up the facility that is available for construction and development of the project. So in terms of term, standby facility will have a term that is very similar to what we have for the base facility. So standby facility is also going to have a long term duration. The next that we will actually have to look at in terms of analyzing the loan feature is the level of risk involved in each of these facilities, right? Level of risk. So if you look at the base facility, it is actually being provided at the earliest phase of the project life cycle, so therefore the risk is necessarily going to be relatively higher. Okay, so the level of risk will be relatively higher. When you come for working capital facility, by the time the construction is already complete, the project is in operation stage. So in the operation stage, the level of risk is going to be relatively moderate as compared to what we have in the construction phase. So the level of risk of working capital facility will be moderate, and what we actually look at for a standby facility is the facility to be used when the expenditure exceeds the budgeted amounts, when there is any exigencies, when there are and unpredicted expenses. So that is actually used to meet the financing needs. So therefore a standby facility is actually utilized only when there are situations which has not been accounted for at the budgeting stage. So therefore when a project starts utilizing the standby facility, it gives an indication that there is something that's going on in a way that has not been planned at the budgeting stage. So therefore the project is probably little bit more riskier if the standby facility is being used. So in the level of risk, the standby facility will, among the three, will probably be the highest. Okay. So now we look at the two characteristics for these loan types, and this will give an indication in terms of which of those loans will have the highest interest rate. So if we compare these two features, we find standby facility has a long term loan and it probably has the highest risk. So therefore in terms of the interest rate, standby facility will be the highest. Okay. And base facility is also a long term loan. So it is a very general rule of thumb that the interest rates in a long term loan is going to be higher than interest rate on a short term loan. Okay. So when we compare on that basis, long term loans are going to have a higher interest rate as compared to a short term loan or working capital facility. So therefore the interest rates on the base facility and the standby facility is going to be definitely higher. Now between these two long term loans, which one will have a higher interest rate? The one which actually has the highest risk exposure will have a higher interest rate. So therefore standby credit facility will probably have a highest risk exposure as compared to base facility. So the interest rate between these two long term loans will be higher for the standby facility. So base facility, the interest rate will be higher as compared to a short term loan. Working capital will actually have the least interest rate because it is a short term loan facility, and more importantly the risk level is moderate because the plant is actually in the operation stage. So this will be the lowest of the three. Okay. So now we could probably get a general idea in terms of why each of these loans are costed in a way that we normally see in practice. Okay, the next question that we put forward is, when will the project company start paying interest on the base facility? From the time of utilization or from the time the project begins operations. So if you really look at it, a base facility is a long term loan, but the utilization of the loan, that is the time at which the loans are withdrawn, is also not at one stage, it happens over a period of time. Let us say for example the base facility is utilized, this is year 0, this is year 2, this is when the project begins operations, right. So the withdrawal of the base facility happens let us say during the project construction phase, which is let us say from 0 to 2 years. Now the loan could actually, part of the loan could actually be withdrawn from time 0, time 0.5 years at the end of first year and so on. Okay. So the interest technically would actually have to be paid from the time the loan has been withdrawn. You actually start paying interest on the loan from the time you actually take the loan. Okay. But an important part of the project life cycle is, during the construction phase the project does not get any revenues, revenues start accruing only when the project begins operations. So in a base facility the loan is actually serviced using the project cash flows. Now when the project does not have any cash flows during the construction phase, how can the interest be paid? The project is unable to pay the interest during the construction phase, but at the same time, since the project has actually withdrawn a loan, you will have to start paying interest. So here is what we have, a concept called the interest during construction. We have what is called as your interest during construction. In industry parlance it is commonly called as IDC. So the interest starts actually accumulating as soon as the loan is being utilized, but the interest is not paid. The interest is not paid to the lender because there are no cash flows. So the interest gets accumulated, and all the interest that actually is accrued during the construction phase is called the interest during construction. And this interest during construction is added to the principal that is outstanding at the time the project begins operations, and that is when the loan starts to be repaid to the lender. Okay, so yes, the interest actually is accrued, but the interest is not paid during the construction phase in the base facility. So the third question that we put forward is, apart from the reasons mentioned in the lecture, what could be the reasons for lower finance costs in a lease as compared to a debt? Okay. So remember, we talked about lease as one of the alternatives of securing capital in a project finance transaction, and then we looked at various advantages of lease, and one of the advantages is it actually helps to reduce financing costs. So when we look at lease, we looked at two reasons why leasing can actually result in lower finance costs. The first reason is the history and performance of the leasing company. So the leasing company would have a longer performance history and track record as compared to the project finance company, and therefore if the project finance company borrows, it will have to probably incur a higher interest rate, but if the leasing company borrows, on the strength of its financial performance, it is able to borrow at lower interest rates, and the leasing company shares some of this benefit of the lower interest rate with the project finance company. So therefore it is able to achieve lower finance costs. So that was reason number one. The second reason that we talked about was the benefit of depreciation tax shields. The benefit of depreciation tax shields. So the reason here is during the initial years the project finance might not really have profits, and therefore it may not be able to enjoy or claim the tax shields from depreciation, and if they are not claimed within a certain amount of time, then the tax credits from non-operating losses expire, so therefore they are not able to claim the entire tax shields. But on the other hand, if the depreciation is claimed by the leasing company, which essentially is the owner of the asset, then it is able to enjoy the tax shields from depreciation, and part of the depreciation tax shields can then be passed on to the lessee, and therefore it results in a lower financing cost. So these are the two reasons that we actually discussed in the previous lecture. The third reason, which is probably more often not mentioned, is can be attributed to the seniority of the payments that is being made to the lessor. So essentially, if you look at it, a project finance company has two alternatives. So it can actually either borrow and acquire an asset, or it can actually lease an asset. Okay. So these are the alternatives. So in terms of the seniority of the cash flow payments in both these categories, you actually find that interest payments are done after all the operating expenses are taken care of. Okay. So interest payments actually have seniority as compared to, let us say, dividend payments, but then expenses related to operations have seniority as compared to interest payments. So then if you really look at leasing, the lease rentals are essentially treated as a part of operational expenses and not really as a part of servicing the lenders. Okay. So from that perspective, lease rentals have seniority, the lessors have seniority in terms of receiving payments as compared to debtors, and because of the fact that there is certain amount of seniority to lease rentals, one is actually able to use this seniority to the advantage and then claim a lower finance cost. Okay. So as the seniority increases, the risk of payments becomes lesser and lesser, and if you really look at it, lease rental is more of an obligation, and its obligation has a lot more weight as compared to the obligation towards the lenders, and therefore this seniority also provides a certain amount of advantage in terms of lower finance cost to the project finance company. So this is a reason that is most often not discussed, and the cost advantage due to the seniority payments might actually not be very large, but at the same time it exists, and we have to be aware of the fact that the lease rentals have seniority as compared to debt service. Okay, but now we will actually get back to the topic of today's lecture. So the topic of today's lecture is financial intermediation. We have to first really understand what is financial intermediation. So if you really look at the financial markets, if you really look at the capital markets, so there are at one hand we have what is called as who need capital, and then on the other hand we have what is called as people who are with a surplus of funds, they actually provide capital. Okay. So people who need capital, they actually approach people who provide capital, and then they get the money, right. So this is common across all. For example, let us look at the retail level. If you are actually taking a loan for your education, what do you actually do? You actually go to a bank and then take a loan. Okay, so the bank is actually providing a loan to service your education, but is actually the bank providing the capital? A bank is not necessarily providing the capital. What you actually do is the bank actually has depositors investing their capital with the bank, and the bank uses the deposits to actually provide you a loan. To some sense, if you really look at it, banks is a financial intermediary in between the investors and the borrowers. Okay, so this is a very simple case of financial intermediation. So bank in the sense it actually provides a capital. Now there are different levels of intermediation. So for example, between these two there are banks, correct? Bank is one level of financial intermediation. Now sometimes it is not possible for, let us say, the borrowers to directly approach the banks, okay, because of so many reasons. The borrowers might not really have the capacity to provide all the requirements that the banks need, and they may actually look for expertise who will actually provide information in a way that will meet the requirements of the bank, which in turn might actually provide the capital. Okay. So what you have in some cases is the borrowers can approach what is called as financial intermediaries, such as your investment banks, and these financial intermediaries act as a link between the borrowers and the bank. So here we are talking about financial intermediation of the next level. So bank itself is a financial intermediary, but between the bank and the borrower there is yet another service provider who actually helps to raise capital for the borrower. So this is the next stage of financial intermediation. So you actually have financial intermediation in the capital markets. It's a very active way, simply because of the fact that the financial intermediaries facilitate to raise capital for the borrowers, and it helps to the financial intermediaries over a period of time develop a lot of expertise about the industry, about the financial institutions, about the banks, and they use this expertise in order to effectively raise capital for the borrowing firms. The question is, why is intermediation needed? Okay, why can't the borrowers directly approach the banks? Let us say, for example, in a case of a simple thing like an educational loan, it is possible for individual borrowers like you, like so many others, to directly approach the bank, because the requirements that are needed to be satisfied to take an educational loan is not very complicated, and there is no greater level of expertise that is needed to actually fulfill all the requirements for taking an educational loan. But now let us take an issue like a project finance. So project finance is a lot more complicated than an educational loan. It involves larger amounts of capital. It probably also carries in some sense a lot more uncertainties as compared to, let us say, a fixed product like an educational loan. So the kind of documentation, the kind of information that needed to be provided to the banks is going to be a lot more complex, is going to be a lot more time consuming, and it would need very specific expertise. And most of the time the banks also rely a lot on the relationship that the bank, for example, an intermediary which actually has a very good relationship with the bank will be able to ensure that a particular loan transaction is getting the right attention as compared to those that do not have any relationship. So unless until you have a good relationship with the bank, it is going to be very difficult to actually get the attention of the relevant people in the bank to look at your deal. So the intermediaries play a very important role in that connection. So the intermediaries have a relationship with several of the banks, and they ensure that because of the relationship the deals and the opportunities are evaluated by the right person. They also actually develop over a period of time expertise in terms of how you can actually position a particular investment opportunity to a bank so that it can meet their internal credit requirements and so on. In essence, they kind of understand what is the information is a bank looking for, what are the various features that will give a bank a comfort in lending to this particular project. So this information might not the project finance company might not actually have the strength and the management capability to handle this. Now the project finance company can actually recruit a person with an experience in raising capital to actually develop a relationship with the bank and so on, but then raising capital in most cases is a one time exercise. Remember, much of the capital is needed for construction, and once the capital is raised you do not really need the expertise during the subsequent stages of the project. So therefore recruiting in-house talent to meet these kinds of capital, to meet the expertise in capital resource is not going to be something that is going to be consistently needed for the project finance company. So why invest in this talent when it is not going to be needed on a long term basis? So therefore by using financial intermediaries, the project finance companies are outsourcing the requirement for expertise in terms that is needed for raising capital. In many sense this could be cost effective, in many sense given the fact that the investment bankers are constantly updated in terms of the recent trends and practices, they will be able to raise loans a lot more effectively as compared to in-house talent. Large corporate houses where there is a need to consistently raise capital and to consistently maintain the relationship with the banks might not actually rely on financial intermediaries. They may actually go ahead and raise their capital using in-house talent. But by and large, if you look at project finance companies, given the fact that capital raising exercises is not a frequent occurrence, they probably rely on external expertise like financial intermediaries. So when you really look at financial intermediation in project finance, broadly see two major categories: intermediaries who provide advisory services and intermediaries who provide arranging services. Now what are these two types of services? Let us look at it in some detail. Let us start with the advisory services. So what are advisory services? So advisory services include a whole range of services that are necessary to package the project, that are necessary to prepare the project for successful fundraising subsequently. Let us say for example, the first point is advisory services would include studies and analysis that are needed to make the preliminary evaluation of the financial feasibility of the project. The first thing that needed to be told to the project sponsors is the project going to be financially feasible? Now for making that feasibility study, one needs to have a lot of information, okay, and obviously if there is no expert is available in house in terms of gathering all the information and then putting it together and then analyzing it, then the project sponsors are better off handling this, using the services of an advisory services firm in making these exercises. So the study and the analysis that is needed to identify, to predict what is the financial feasibility of the project is a part of the advisory services. The second part is, once you have identified a financial feasibility, you should also look at what are the different project risks, and the advisory services company will also help to put together a risk management framework that can address all these risks. An advisory services firm will also expected to assist the sponsors in preparing and negotiating the major contracts. Remember, contracts is a part of a risk management framework, and since advisory services includes identifying what are the risk management practices, they also will be assisting the sponsors in negotiating major contracts. The major contracts could be a fuel supply contract, it could be a customer agreement like the power purchase agreement, it could be like engineering, procurement, construction contracts, and so on. So entire list of contracts and that are needed for the project finance company, and the advisory services firm can assist the sponsors in the various arrangements. And then the most importantly, before the project is actually being taken to the lenders, we need to actually have a business plan for the project. So the business plan will provide details in terms of what are the expected revenues, when are the revenues expected to occur, and how much are the revenues expected to grow. It will also talk about what are the expected costs going to be like, and then what is the profitability of the project over the years. So essence, it talks about the sources of revenues, it talks about the profitability, it talks about various other features in terms of how the capital is going to be utilized, and so on and so forth. So this business plan is a very important document, and the advisory services firm will play a very important role in putting together the business plan. So obviously the advisory services firm cannot work independently, they will have to work closely with the sponsors, and in some cases if the business plan is being prepared by the sponsors, then the advisory services firm can review the business plan prepared by the sponsors. In cases where the sponsors are unable to prepare a business plan, then the advisory services firm will have to take the responsibility of preparing the business plan. And importantly, the advisory firm will also have to act as a sounding board for the sponsors. Now sponsors will probably understand the business opportunity well, but then it is possible that sponsors probably have their own what is called as your blind spots. Okay, so the advisory services firm will have to actually highlight the problems that the sponsors have not considered, the sponsors have probably overlooked, and it is important that they actually resolve some of these issues before they can actually take the project to the lenders. So these problems that the sponsors have not considered or overlooked have to be resolved for the deal success. So we looked at the main features of components of advisory services, but what are the activities that are involved in advisory services? Let us say how does an advisory services spend its time, okay, and what are the different activities. Now as soon as an advisory firm gets a mandate from the project company that they have been mandated as an advisor, they will have to do a whole lot of activities. Let us look at some of the main activities that they have to spend their time on. The first thing is they will have to start gathering a lot of technical, legal, and fiscal information regarding the project. For example, how long is going to be how long it is the road is going to be if it is a road project, what is the kind of a terrain that we are looking at, what is the kind of technology that is needed, what is the kind of engineering that is needed to develop the road project, and so on. Right? So if it is going to be a power project, it talks about what is going to be the kind of technology used for generating power. It is going to be thermal, or is it going to be CCGT, what is going to be the capacity of the plant, what is going to be the fuel quality, based on which the cost of the equipment is going to be decided, and so on. Right? So that is one. The second is the legal. What are the clearances that are needed for the project, right? And who are the agencies that are responsible for getting the clearances? who should be approached for getting the legal clearance, for getting the environmental clearance, who should be approached for getting clearances related to other approvals like right of way and so on. So this information needs to be obtained, and we also need information in terms of the broader economy, right? How is demand expected to be for the services, and what is going to be the price that the consumers can be able to pay for the services and so on. So there is a lot of information gathering that is needed at the beginning, and the advisory services firm will expected to spend a lot of time in getting this. Now what next? So once you gather all the information, this information have to be put together in a business plan. Okay. So obviously business plan will have to depend on the initial information gathering exercise. So therefore the soundness of the business plan will strongly depend upon how exhaustive has the information been gathered, how accurate the information has been, and how complete is the information has been. Okay. So business plan development is also very exhaustive exercise, and a sound knowledge of the ground realities are needed for preparing the business plan. So business plan will also have to be will also be getting a lot of information from the project sponsors. Now after developing the business plan, what next? Okay. So after developing the business plan, the next would be to find out how do we actually finance this business plan, okay, and what will be the sources of capital, how much will be the debt, how much will be the equity, and who are going to be the sources of debt, how are we going to source equity. Okay. So that is going to be the next step in terms of what will be the sources of capital that we will approach for funding this business plan. Once we have crossed that stage, the next would be to prepare what is called as your project information memorandum. Project information memorandum will talk about the entire project details. Essentially this is a memorandum that is circulated to the lenders. So the targeted readers would be the potential lenders who are going to invest in this project, and the information that would be of interest to the lenders will be put together in the project information memorandum. Essentially at the end of it, if you see, the sum and substance of an advisory services firm is actually to provide a lot of services related activities to the project sponsors or to the project company, and which will actually help the project finance company to successfully raise capital. The advisory services firm has no commitment for providing capital to the project finance firm. They may be interested, but as an advisory services activity, they do not have to provide any commitment for lending to the project company. Now who are these firms who provide the advisory services? So you actually have consulting companies, whoever are active in the infrastructure space, they have services to provide for these kinds of services. The next category will be, let's say, auditing firms. So you have Ernst & Young, Deloitte & Touche, Pricewaterhouse. So these are all major global audit firms, and the corporate financing divisions of these global audit firms, they take up advisory services in a very active way. And then you have commercial banks who also do lending, and as a part of their project financing activity, commercial banks also have advisory services. For example, commercial banks like ABN AMRO, Societe Generale, Deutsche Bank, some of these large banks, they also provide advisory services. And then you have the investment banks. The investment banks are largely responsible for raising capital for the project finance company. In some cases, along with their arranging services, they also provide advisory services. So there are different categories of firms who actually provide advisory services, depending on the need, depending on the kind of advisory arrangement that the project finance companies have. They can approach any of these firms to provide this, to get these advisory services. So the next we have what is called as arranging services. Arranging services are provided by firms, and they are responsible for raising capital for the project. Okay. Remember, advisory services actually provide all the relevant information which will help to raise capital, but arranging services actually are responsible for raising capital. So that is the difference. So normally arranging people who actually provide arranging services, they have relationship with a large number of banks who make investments in these kinds of projects, and once they get a mandate from the project company that they have been appointed as an arranger for the project, then they will actually get in touch with the banks whom they have relationship with, whom they think will be interested in investing such a project, and then circulate the project information memorandum. They will actually invite the banks to participate in the deal. So whenever they invite, they will also have to be circulated the project information memorandum. So that's a first activity that the arranging services provider do. And once we have a group of investors who are interested in investing in the project, they actually represent all the lenders who are going to be investing in the project. Remember, for a project finance company, interacting with each and every investor is going to be very difficult, given the fact that most of the project finance investments are going to be very large. It is very unlikely that the entire capital will be provided by a single lender. You have what is actually called as a group of lenders coming together and then providing capital for the project. So this group is commonly known as the syndication. Most of the project financing loans are actually syndication loans, in the sense that you have more than one investor investing in the project, and therefore when you have such a group of investors coming together, you need to have one representative who will interact with the project finance company. So that representative is a company that provide the arranging services. If you look at the types of arranging, they can be broadly classified under two categories. The first is the best efforts basis. So the best efforts basis of providing arranging services means that the firm will actually do its best, will put its best efforts in terms of raising capital, but it does not give any guarantee that the capital will be raised. Okay. So there is a lot of uncertainty in this type of arrangement. If there is any sudden change in the external environment, or if there is some new information that can cast, let us say that can provide some adverse information on the project, then the arranging firm can actually withdraw and say that it is not able to actually raise the capital that is needed for the project. So the best efforts basis is certain amount of uncertainty for the project finance company, because the arranging services can always come back and express its inability to raise capital for the project. The next is the guaranteed basis. So guaranteed basis indicates that if the arranging firm is not able to raise capital from other lenders, then it will be in a position to invest its own capital for the project. So the arranging service, the arrangement is on a guaranteed basis. They are guaranteed to raise capital for the project. So whenever we are talking about this guaranteed basis, obviously only firms that are having a substantial amount of capital will be able to provide this kind of a guarantee. Remember, a firm which is not having the financial capital but then provides a guarantee that it will be able to raise capital is going to get into serious problems if there are no interest from the side of lenders. So therefore, normally you actually find firms providing arranging services also have the financial capital to invest in the project, unlike the case of advisory services. In the case of advisory services, the firm might not be able to bring in the capital to invest in the project, but in those who actually provide arranging services will be able to get their own financial capital to invest in the project. So that is another difference between an arranger and an advisor. How does one select an arranger? So if you kind of look at the industry, there is what is called as league tables. League tables indicate a ranking of the arrangers based on how successful they have been able to raise capital. So the ranking in a league table is a very important indicator of the expertise, success, and the experience of the arrangers. So people look at the rankings in the league table as one of the important criterion to actually provide to actually select the arranger. So, there are the other inputs such as experience, reputation, the flexibility of the arranging firm in terms of meeting the needs of the project finance company can also play a very important role. Sometimes you have an arranger who has excellent reputation, a lot of experience, but if he is not able to provide a flexible service that meets the project finance company, then they may not be able to get the mandate. It also the cost of financing also plays an important role in the selection process. Which of the arrangers are able to provide financing at the lowest cost? Okay. For example, there is an arranging fee that is involved, and which of the arrangers is able to arrange the capital at the lowest arranging fee, that's a cost of financing. The cost of financing also includes the cost of debt. So, the arranging fee as well as the cost of debt is jointly referred to as called as the cost of financing. So, which of the arrangers are able to arrange capital at the lowest cost is going to play an important role. And also importantly, the relationship is also an important. If an organization has had a very successful relationship with an arranger in the past, it is very likely that that relationship might continue in the future as well, provided the arranger is able to provide a competitive arranging deal. So, the past relationship, in addition to experience, reputation, flexibility and cost of financing, also plays an important role in the selection of arranger. There are also other loans in a typical project finance loan structure. Let us quickly look at some of them. So, you have what is called as your lead manager, manager and co-manager. So, these are titles that are given to the lender depending on the commitment that they make to the investment. Let us say, for example, the project loan size is $100 million. Now, depending on the commitment the investors make, they are given, let us say, a specific title. If an investor is able to invest $25 million, then he will probably given a title of lead manager, right? And if an investor is able to make a commitment for $15 million, then he is given a title of manager, and co-manager title is probably, let us say, for 10 million. So, this title reflects the amount of commitment that the investors have made in the particular project. Okay. More the commitment, higher the title that you will be able to get. Now, why are these titles important? These titles are important because the titles decide your reputation in the project finance market. So, if you are in a lead manager for a large number of transactions, then you are probably going to get a lot more weightage as compared to a manager title. Okay, so this actually decides your decides the commitment, and also provides strengthens your reputation. Then we have what is called as your participant. Okay, a participant in a deal provides what is called as your the lowest investment amount. Okay, so a participant can actually provide what is called as your 5 million. So, then we have what is called as a documentation bank. Documentation bank is responsible for drafting the documents concerning the loan. So, you need to actually draft a loan agreement that has to be signed by all the people who lend for the project, all the investors in the project. So, there is a specific bank which actually is given a responsibility for drafting this loan agreement, and that is called as your documentation bank. Then you also find what is called as an agent bank. An agent bank is responsible for managing the SPV's cash flows. Remember, these loans are fairly for a long duration, and there has to be somebody who will be responsible for ensuring that the lenders are paid on time, the loans are being serviced on time. So, for that we need to actually ensure that the cash flows are being managed properly. So that is a particular bank which is referred to as the agent's bank, which manage the SPV's cash flows and so manages the payments during the loan life cycle. Okay. So in addition to all the other players that we have seen, we have, like say for example we have the arranger firm, and then we have the advisory firm. These roles also play an important role in the project finance transaction. Now obviously for all the services they will have to be compensated. For an advisory services firm, there are let us say what is called as the different types of fee structure. We have what is called as a retainer fee. Retainer fee is provided to the advisory firm to take care of the expenses that are incurred in the efforts that the advisory services firm will have to put in. And then we have what is called as a success fee. If the project has been able to successfully raise capital, then the advisory services firm gets a success fee. A success fee is a proportion of the size of the deal. And then there is what is called as the out of pocket expenses. If there is any expenses related to travel and other expenses, then the advisory services firm is reimbursed those expenses. For the arranging services firm, there is something called as the arranging fee and then the upfront management fee. The arranging fee is a fee to compensate for the services in arranging the to compensate for the effort in arranging the loan. For example, the arranging services firm will have to contact the various banks and circulate the project information memorandum, will have to probably address various queries that they might actually raise, and in a sense help the different banks to manage their internal credit approval process. So the services, the several services that is needed, and the effort, this arranging fee is to compensate for the effort that the services firm provide. And then we have what is called as the upfront management fee. The upfront management fee, also called as the commitment fees in many instances, is actually fee that are provided to the different investors to compensate for the efforts that that they will have to do for evaluating the particular investment opportunity. Okay. So whenever the different investors get a project information memorandum, they will have to spend time, they will have to understand the project. So there is a lot of effort involved in terms of evaluating and processing the investment opportunity. So this upfront management fee is provided to various all the lenders on the basis of the commitment that they make. So for example, if the lead manager makes a commitment of 25 million, then the upfront management fee is a part of this. It could be, let us say, 0.2% or 0.2% of the commitment amount. So that is how the usually upfront management fee is calculated. So if an investor is able to invest a lot of money, then the upfront management fee will also be higher. Okay, now we will come to the thought questions for today's lecture. So we talked about two major categories of intermediaries. We have advisory firms and then we have arranging firms. Okay. So the question is, should the advisor and the arranger roles be done by separate organization or the same organization? Today we also have organizations who provide both advisory and arranging services. So the question is, what is appropriate? Should both the services be provided by the same organization or should it be different organizations? What are the advantages and limitations of both the approaches? So the second question is, usually the advisory firms are provided a success fee upon financial closure. Now should the success fee be calculated as a percentage of debt value or as a percentage of project value? Okay. Let me repeat the question. Should the success fee paid to the advisory services firm be calculated as a percentage of debt value or as a percentage of project value? Okay, so think about these questions and we will discuss in the next session.